Welcome to another episode of the SWISH Show, where, as always, I'm your host, Ryan Tuckwood, and today I'm excited to bring to you someone that is not only an experienced and active investor, but he's somebody that purchased 19 properties, and happy to be corrected along the way, but 19 properties before leaving his career as an engineer, which I would also like to dissect more as an ex-engineer myself. Due to his dedication in building this large, positively geared property portfolio, he was able to retire from his day job at the age of just 28 years old. Who would like to do that? Currently, Scott owns 28 properties, but I have a feeling that might have increased as well. However, more importantly, this property portfolio returns hundreds of thousands of dollars every single year in passive income, making him one of the most successful young property investors in Australia. But most importantly for everybody listening, he has a passion for all aspects of property, especially helping other people find great deals. Scott, welcome to the SWISH Show, mate. How are you?
Very good. Thank you for having me.
Happy New Year to you, mate. Decent Christmas, and did you get some time off over the break?
Yeah, just the couple of weeks, so couldn't really travel too far as well. So it was sort of one of those funny years with all the border closures and, getting told to not go anywhere with COVID, but it was good. We actually found it was very relaxing, not doing too much.
Yeah, nice. And on that note then, I guess straight into something that I've struggled with over the years. Do you have an ability to switch off? Can you go home and just forget about everything based around all the success you've had, right? You're obviously quite entrepreneurial. Can you do that?
Look, I struggle, to be honest, but look, this year was better than normal because I don't know, I just found over Christmas the emails do drop off a little bit. But yeah, look, I'm one of those guys that, you'll see the emails hit the phone and, you've got the answer there, so you may as well just get it done. And yeah, I don't think a business owner really ever switches off. That's what I've experienced talking to similar people to myself, and it's just the way it goes. When you're working for a salary, it's a lot different. But yeah, look, you got to enjoy it. I guess that's the fun of it.
Yeah, for sure. And I've obviously done your bit of a corporate intro there, mate. Just doing a quick 60 to 90-second synopsis for anybody that maybe haven't heard of you and what you've achieved just yet. Just give us a quick overview in your words of who you are and what your life looks like a little bit.
Yeah, so my name's Scott O'Neill, 33 years of age, born and raised in Sydney. I grew up in an area called the Shire, so that's southern Sydney. And I studied engineering. I was doing civil construction, so building railways and, working very long hours. And I guess that's what kind of prompted me to get into property investing, because when you build railways, you've got to do a lot of the work when it shuts down. So that means night works, Christmas Eve, New Year's and all that kind of stuff. And I didn't see it as a long-term option, and property investing was a way to escape, because it was the idea of maybe bringing retirement a little bit closer. Whether it was 5 years or 10 years, it was always going to be a win as long as I could shorten the work life. And the way I thought I'd do it was chasing properties with high yields. So my wife, Mina, and I invested very differently. So I've been with my wife, married for about 5 years, and met her about sort of 10 years ago, which is roughly when we bought our first property. So she was there from the start, which was good. And yeah, we targeted properties that would pay us back an income. So after all the expenses, we're still left with an income. So every time you buy a property that's positively geared, it's like buying yourself a pay rise. And most people at the time I knew were buying negatively geared units or, a house to live in and just acquiring a lot of debt and not getting much return for it. And this little side hobby turned into a passion because we kept buying and the properties kept growing in value and kept working harder and harder. And that meant, earning better money as well, which meant we could purchase more properties. And long story short, like you said in that intro, we had about 19 at the age of 26, had about 28 it was about 25 at the age of 28, now 33. We've got 32 properties, but we've pivoted the portfolio in recent years. We're now all commercial. So we've still got a lot of the residential properties, but we find the returns in commercial are so far superior, it's almost not funny. It's not comparable. And this has been able to generate an income for us. And we're sitting over 450 grand passive income. So we don't need to work. And we work in this job because it's a passion, it's a way of staying in touch with the market. And, if you're a property nerd, you're probably going to stay that forever. And being able to help others is a way of selfishly staying in touch with the market, but also allowing others to do what we've been doing. And we've been able to help over 2,000 clients now. We've purchased over $1 billion in property over the years. And yeah, we're sort of getting busier by the day at the moment. And it's all because this strategy does work. And yeah, it's not rocket science. It's just we're buying properties with much higher cash flow than what others are finding. And it's a very, very just direct strategy of following that. And it works, I find, in this current market.
Yeah, nice. I'm going to come back to the strategy in a second, but take me back then. So you're working, maybe I can relate a little bit, but I definitely wasn't on the railways, but I was 12-hour days, 12-hour nights, covered in grease and oil, with a sort of burning desire at the back of my mind that maybe just maybe there was something more out there for me, even though I didn't know what it was. And it took a real deep and meaningful with a Scottish guy called Merv for me to realize that I needed to jump ship and leave the engineering world after 8 years. You said real estate and investing in real estate sounded like a better proposition for you and would draw retirement closer for you. But where was that seed planted? Is that from family members, parents? Were they property investors, or where did that all come from?
Look, they were, but they followed the opposite strategy I followed. So I kind of learned what I didn't want to do from them. Like, they bought the standard, a couple of houses, and they negatively geared it and claimed a tax deduction. The problem with that strategy is it relies on you having a high income and working to actually get any of it back. And that means you don't retire until the rents increase and maybe have 20 years of growth. And it was too slow for me. So it's a little bit more impatient. So that the seed was planted indirectly from that, I guess. And it really was just planned. Like I guess it evolved over time. Like we kept getting good results in property. And I remember when we had about 5 properties at the time, and then the market all grew about 10%. And I made more money just through that capital growth than 3 years of salary. And I didn't do anything for it. And I just thought, well, this is just, it's a no-brainer. Like, I didn't put any hours yet. I'm working 50, 60 hours a week in my job, and I made less money in that. And that was probably the moment where I'm like, all right, this needs to be taken more serious. And yeah, we just invested more time into it, and did put a lot of time into it. Like, I'd get home at work and put 4 hours every day after work searching for properties, putting them all in spreadsheets, rating them, out of 10 for rent relatability or capital growth prospects or value add. Like, there was a little system we used, and I letterbox dropped hundreds of properties as well that I liked when I saw, because I was on the road for my job as well. So I liked buying unit blocks at the time. So that was a way of buying a high yielding residential asset, 4 units on one title, and lived in Port Macquarie at regional New South Wales. So we got to see, I guess, how the other, how regional cities worked, and, spent a lot of time between Byron and Newcastle, just sort of on that area. And yeah, we invested in these spots, and they all did very well. And yeah, it was just that type of, system that did us really well, and we ended up, purchasing over 20 million in property through this strategy.
And when you went out to buy your first one, then, I don't know if you can remember it. You remember the first property you bought and how you felt as you're about to do it? Yeah,
it feels like yesterday. So it was 2010. I was in Sutherland, Sydney. It was a little house in Granny Flat. So it was $480,000, and it was renting for $660 a week. So that's pretty good yield for Sydney. It actually worked out to be about $200 a week passive income. So after you minus the mortgage rates, I allowed $2,000 a year in maintenance. All those types of costs were accounted for. And it was a 10 grand pay rise. That's how I looked at it. But that 480 grand property over the next 3 years turned to 1.1 million as well. So that was equity that we could then use for other ones. So that's how we got into the second and third properties. So it's not just about cash flow, it's about the growth. But was a real ugly property, to be honest. It was near a highway. It was, well, not a highway, but a busy road, fibro. But it was that granny flat out the back, which is almost, in 10 years, I've had maybe 4 weeks vacancy. It's always filled because it's near a train station. There's always someone that needs a cheap place to live, and that's it. And it doesn't need to be beautiful. It doesn't need to be, a designer home to do well, but that, it's in the right area and it's at the right money for the tenants. So a house in granny flat worked very well for us for that first.
That's a really good point, right? Because and we said just before we started recording here that back in 2017, my ex-business partner Jack and I created a real estate investment company that's still running today. And one of the challenges that we faced was that people wanted to buy the most beautiful places and investment property, and they were getting emotionally attached to their portfolio. You would have seen the same, but you were able to see past that, even with the first one that you bought. Was that more luck than judgment, or did you have that foresight from day one that this is a business, not an emotional?
Yeah, and look, that's the engineering side, and my father's an accountant, so it's pure numbers, spreadsheets all day, and that's what we looked at. And the good thing about I remember showing my wife Mina the property, and I was almost embarrassed, to be honest. So we were walking up going, what's she going to think? This is going to look terrible. And she just asked, look, is it going to pay us back money, each week? She was automatically thinking that positively geared mindset. And I said, yeah, look, it'll probably give us about $220 a week after all costs. And the way I looked at it at the time, selfishly, was that was our European holiday paid for just from the rent. And because, and we went in that with a $60,000 deposit at the time. So that we saved that over a 5-6 year period. I was working in bars, started at McDonald's, and it took everything to save that. So that was our life savings into that property. And getting 10 grand back, that was a great result. And then the growth was the bonus that I guess we never really thought would happen that quickly or much. So yeah, no, it's all about the numbers, and the look of it doesn't matter as long as it's livable and it's the right demographic, which we explore, of course. And that's how it worked for us.
So you just touched on one there about demographic, and you've kind of covered it a little bit already, but talk to us about some of the key indicators that you're looking for when finding a property, whether it be residential or commercial, industrial.
Yeah, so different things. So residential, we look at affordability. So is the medium income to average house price sensible? So in Sydney, it can be 12, 13, 14 times the average income to buy the average house. So as a result, we don't buy in Sydney anymore because I don't see value. And look, there are pockets where there is value. Like, I'm not generalizing completely, but we've been buying a lot in places like Brisbane and Adelaide and now Perth, because the income is actually quite affordable for the average house. So affordability is a growth driver. If people can afford to pay more for houses, then over time the economy will wash that out and push prices up. So that's one. Tight vacancy rates is another one. You want to see sub 2% rates. So if it's under 2%, 3% is a balanced market where there's sort of like an equal number of tenants looking for the properties available. But when it gets under 2%, that's a tight rental market. What a tight rental market means is rental growth. What rental growth means is the increased cash flow, because investors are going to then seek a higher return, and that will cause more demand down the track. So a tight vacancy rate is a forward indicator of growth as well. So we like targeting that. And like freestanding houses, look, with the exception of some really well-placed townhouses, but generally you want land because, especially if you're a young investor, holding land for a 2 or 3 or 4 decades is going to be better than buying up in a unit block that's probably going to be a knockdown in 40 years, So, land. And when it comes to, because we do a lot of commercial, we look at what the business trends are doing. So right now with COVID, people aren't going into the offices as much, so we don't target offices, but people are buying a lot more online. So that means logistics and industrial space, warehousing space is really valuable at the moment. We're seeing quick growth rates in that. And it's quicker than the best of residential right now in some areas. We're seeing double-digit returns, even in growth, and then you're getting 8% net yields as well through that from a cash flow point of view. And then obviously like medical and all that stuff. So we go into all sorts of corners of the economy to see where the value is. And yeah, but look, that's sort of a bit what our business Rethink Investing does on the side.
And is that that's a full-time job in itself, right? Researching the market and growth areas and trends. Are you day-to-day involved in that, or have you now built a team that do that study for you?
Yeah, look, you can't not be involved in it to a degree. Like I read the news, you know what's doing. But look, I am actively involved in negotiating in properties every day of the week. Almost every 4 hours we're negotiating a property. So I guess you can see on the cold face how busy things are and what prices they're going for. Understanding what the tenant market's doing is very important, and that's look, that's what we do. And yeah, we've got a team, but I think it's important to always be across that if you're an investor. It's like if you're playing in stocks, you don't just all of a sudden totally lose interest in it while you still got shares. You need to follow it, because if there's a time to sell out, you'll know.
Yeah, it's interesting. We get asked that a lot, as obviously we're sales trainers, and it's like, well, so do you still get on the phone and sell? I'm like, absolutely. I want to twofold. Firstly, I love it, and then secondly, I want to keep my sword sharp as well. So I might just elegantly segue into sales just then, because you said you're negotiating a property every 4 hours, which is an unbelievable stat, by the way. How important is negotiation training for you, and sales training for somebody that gets into this type of business or industry, and what have you done over the years?
Yeah, look, I think without being a good negotiator in property, because every little tactic can be $100,000 here or there, or you can't overpay because you're dealing with big dollars. Like imagine you're negotiating on a $5 million commercial center and you're 1% off. That's huge money. And I found the only way I've been able to negotiate very well is just knowing the market extremely well. If I know the market better than the person on the other end, it allows you to come back with confidence. So it's not about sort of crushing the opponent, or you want to create a win-win solution with the negotiation. But part of that is helping them understand the market if they don't know. And because think about when an owner's selling a property, their heads might be in the clouds with the price. So we need to help educate them. Here's the comparable sales. Here's the square meter rates you should be going off. You're way off. We're not trying to offend you, but we're just trying to be fair on our price, and just bring them down to earth with stats is how we work.
Elegantly, right?
Yeah.
Yeah, for sure. Okay. And then in that regard, then you're obviously extremely busy still, but the passion is there with it. You and Mina are in this together. Does she work full time in the business?
No, look, she's we had a baby a year and a bit ago. So look, she works probably 1 or 2 days a week. She's more involved in kind of the HR side of things, because I'm obviously talking property all day and that. So yeah, it's good to have that in the background, and she does help with that side of things. So yeah, look, it's a busy team, but look, as long as the passion's there, it's not really work, right?
Yeah, 100%. And you, again, similar to myself, I've got a couple of young boys, 2 years old and 10 weeks, and you've got one that's 13, 14 months old as well. So balance, mate, does it exist? How are you juggling everything at the moment?
Yeah, look, it's hard, and I think that's just the business owner's problem for life. And look, I think we do travel every year for the last 6 years in a row, except for 2020. We've spent at least 3 months overseas. So what I normally do is work my arse off all year round, except for 3 months, and then switch off as much as possible. And look, don't get me wrong, you look at the emails and sift through the important ones, but having that real proper switch off for a long period of time. Like, we're out of the country in a different time zone, normally Greece. Like, we've bought a property over there, and like, it's hard to even link up with the bright hours. Like, it's just like the UK, like the hours are probably the worst possible case. As soon as the work hours start in Sydney, people start sleeping in UK and Greece and Europe, and it doesn't really link up. So there isn't much overlap, which is a good thing. And then you come back with the fire in the belly, ready to, work harder than you would have previously.
Yeah. Was that a conscious effort, Scott, to get onto a different time zone so you would switch off if you were taking 3 months away, or is that just a
Look, my wife grew up in Greece, so she's pretty much family's there. So and look, I loved Greece as well. Like we go there and you fish and it's just like it's just the beach culture and it's so relaxing. And like from Greece, you can go all over Europe in a 2-hour plane flight, which is great. So we don't just sit in Greece. We might go, went to Scotland last year and then Croatia and, went around sort of Hungary and places like that, depending on what you feel like. And it's all fairly cheap to fly around there. And Greece is just a base, but it's a real relaxing base. So we bought there for my wife's family. And obviously I couldn't have picked a better spot, to be honest. I'm glad she wasn't from Iceland or somewhere cold. So.
And so with what happened with COVID last year, then the travel restrictions, did you still take 3 months off?
No. So 2020 was our busiest year ever because kept working really. And so look, we actually booked the tickets to Europe in July this year. So we'll see how that goes. We might not be allowed to go, but yeah, look, we're planning to get back into the habit, and I guess we'll see what the government says with what we can and can't do. But yeah, last year was the first year in 6 years that we've seen winter, because we normally skip winter in Australia.
Yeah, cool. And you just touched on it being a busy year, not just for the fact because you were here, but also it was a very busy and productive year in real estate in general. We coach a lot of people in that industry and found the same thing. Firstly, why do you think that was, bearing in mind everything that was going on? I think I probably know the answer to that for everyone else listening. And then what do you see happening whether we don't know if we're post-COVID, but let's say 2021 and this year, what do you see happening with the property market?
Yeah, so real quick snapshot. Last year started off really strong, and then COVID was in the news in the background. It started creeping up worse and worse. March was a bad month for property. Everyone got spooked because we didn't know what was going to happen. And then April, they announced JobKeeper, and all of a sudden a lot of confidence returned. So we found basically it was almost about 80% recovered by the end of April. And May, June, July, like all the following months were just sort of a slow improvement. But what really, stuck out for me last year was November, because that's when they cut the interest rate just after the Melbourne Cup period. It was like that just put a fire under the market. Everyone just started going, all right, I need to buy. We saw prices quickly start growing. And Christmas, like I remember we were working on the 24th, right up to everyone was just so busy trying to get deals done. And I think that's just going to continue. So the cheap interest rates and the fact there's nowhere really great to put your money right now. Like if you're an investor looking to put your money safely away, like you don't just leave it in the bank collecting 0% interest, because you're going to go nowhere in a hurry doing that. And the stock market's volatile as well. A lot of people don't like doing that, especially when you're talking house deposit levels of money. So houses represent safety, and COVID's actually shown that people value their house more than ever. Like they're spending money on renovating it. Like Bunnings has had an incredible year because everyone's spending money and, everyone's eating at home. Like the home is important. And same goes for certain parts of commercial. Like we found that it's never been more important for industrial properties to be around, because the likes of Amazon and your Kogans of the world, they're doing incredibly well, and they need storage and all the logistics side of things that go around it. So I'm predicting 2021 to be probably the best year we've seen in almost my lifetime with property. Off cheap rates, there's nowhere better to put your money, and consumer sentiment's at 7-year highs. It hasn't been this high since 2014. And if you look back at 2014, what happened to Sydney after it, it was a pretty good few years. So I'm not saying Sydney's going to boom like it has, because it's at a pretty high level from an affordability point of view, but there's other markets that are going to do very well. Yeah.
Okay. And you've gone on a personal level and a business level, you've gone fully commercial investing. Is that 100% now?
Look, no, business-wise, we're probably about 85% commercial and 15% residential. So we'd still do residential. And the main reason is there's still good deals out there.
Yeah.
I just can find better deals in commercial. And You need about $50,000 as a deposit to start in residential. That's about a minimum deposit to cover your stamp duty. That'll buy you a 350 grand house in, another capital city or major regional city. Commercial, you need about double that. You need about 100 grand. So there's a lot of people that don't have 100, and rather than not invest, you're still better off getting in a good growth market, waiting a few years, and then maybe get into commercial later because the cash flow is so much better.
Yeah. So if we get down to what Rethink does as an organisation, then you take people of all experience levels, people that have never invested in property before, and you educate them and hold their hand all the way through.
Yeah. So we definitely do educate. So especially with the commercial side of things, like most people don't really understand it properly. So our job is to help people understand as much as possible, and we do a lot of articles and podcasts on the topic, because the more you understand about it, the more you'll actually get excited about it, because it is a really good way to invest when you do it properly. But yeah, look, there's residential wise, we deal with people that are 21 years old with their first ever deposit investing. My oldest client was 81, so we've gone up to the other end of the spectrum. So we help everyone, and some of the clients are big business owners, and others are just getting by with their first property, trying to set their family up. So investing can be for everyone. There's just a different price point for everyone, and it doesn't matter what you do as long as you're trying to move forward.
And what are you seeing that people are making as a mistake then when they're buying in, or maybe they've tried something before and they're apprehensive about doing it again because they've been burnt, or they've just made an obvious mistake? What do they look like?
Yeah, so probably the main one I see is just probably getting the wrong advice. So they take advice from someone who hasn't actually done that great with property. So it's like you're taking advice from your uncle who's, never invested in property, but he's saying buy down there because it's a great result, or don't buy that because it's too risky. Who are they to give an opinion if they've never really done anything? It's like getting specialist doctor advice off your plumber. Take advice from the trained experts. The other one is probably investing in your backyard. So just because you're familiar with your suburb doesn't mean you need to invest there, because it's like, I use the analogy of like, if you're looking at shares, you don't go buy Commonwealth Bank shares because their head office is down the road for you. You don't care for that. It's got nothing to do with it. You buy the shares if there's value in them. Or the dividends are what you're looking for. So it's not about the location, it's about the best opportunity. And a lot of people just default to investing within 10 Ks of where they live. And unfortunately for many young Australians living in Melbourne and Sydney, those local areas are so expensive that means they need to go into a high-rise unit to afford anything. And then you're stuck with the strata and the oversupply and all the other problems that go with those types of investments. So that's a big mistake.
And obviously, because of that mentality or that conditioning that we've got, then there's lots of people out there that are missing out on opportunities, or you don't know what you don't know. So what's the solution there for you then? Is that to get this type of education right at the front end, at curriculum level, at schooling?
Yeah, look, I found I've been running Rethink Investing for about six and a half years, and I found in that time it's got a lot better. So when I first started, everyone was like brainwashed to negatively gear because that's what their accountant told them to do. And like, if you're a young person, you're on 80 grand a year and you're getting told to negatively gear and then you've got no money left over, that's just the silliest advice I've ever heard, because that's not going to help you retire. It's going to hold you back. And then if you lose your job, you've got to sell your property because you can't make your mortgage repayment. So thankfully that is very rare these days. There's a lot more education online. Like it's everywhere. Like it's podcasts like yourself, and you pick the right people to listen to, and you listen to probably a bunch of them, and then you end up sticking with the ones you like. And it's because they're saying giving the proper advice. So yeah, I'm happy to say that the misinformation is a lot rarer, but there is still a lot of sharks out there. Particularly, like, I don't really like my industry in terms of its reputation. Like real estate has a lot of, they call project marketers, which sell you off the plan apartments, and a lot of them can be good, but a lot of them could be just the total wrong investment for that individual. But they don't care because they've got to sell a particular asset. So that's where it just gets a little bit, you've got to be a bit careful with property.
Well, on that note, being careful with our language, red flags and green flags, right? Because people are getting phone calls every day from random people, wanting them to invest in different off-the-plan opportunities, commercial, industrial, residential, whatever it may be. How do we know who to trust? How do we know who's actually legit and not?
So the easiest way is, how do they get paid? So if you are retaining, and like, let's say, so I charge my clients, they retain me to find them the best investments in Australia. A project, like if someone's selling you off the plan, they're probably getting paid by a developer. So they're actually working for the developer. That's what you need to understand. And if you can get your head around that, that's fine. But they're not there to get you the best investment in Australia. They're going to say, look, I got a building at 24 Smith Street. It's the best investment because what? Because it's their one to sell. So it's just the red flags are who's paying them. If it's a developer, listen to them, but don't take advice from it. It's because there's probably going to be an inflated project management fee involved. Another thing would be just who they are. Like real estate agents all across the country are representing the vendor. So, and I love many real estates, and there's some that I don't love, but real estate agents, their only job is to get the best price for the vendor. So that's fine, respect that. But if you're an investor trying to seek advice from someone who's trying to get a higher price for their vendor, they're not representing you, they're representing the vendor. So just recognize that, and you won't get caught out too much getting the wrong advice. Yeah, and
yeah, great.
Yeah.
Awesome. Talk to me about legacy a little bit. It's probably an overused phrase, but you got 32 properties. Some people might go, when's enough? And why continue to do it? I know there's the impact side of things as well, but do you have that sort of overarching number that you're wanting to hit? And if so, why?
No, look, I'm actually looking to sell. So what my long-term goal is to probably sell down a bunch of my residential ones and acquire less but higher value commercial assets. So managing 32, like my poor wife does most of it. It is a part-time job, just that. Like there's always a maintenance bill. There's always, because in that 32 properties, there's a lot of multi-tenant properties. So we've probably got nearly 50 tenants in that. So there's always someone leaving. There's always someone who's got a problem with something, and it is ongoing. So I would rather declutter that, and I'd rather 5 very large, medical centers, for example, than 30 properties. Like it's not a number thing; it's about the income. And this is an important note. It's not how many properties you have; it's what that produces you. And it's like the same thing. Like, would you rather have 20 businesses all making 10 grand a year, or one really good one? It's you can use that analogy to a degree. So decluttering will be part of it, but acquiring even higher value, better quality stuff, because that's a better legacy to leave children and all sorts of things, because they're going to look after them forever.
And you're leaving them less headaches as well, because you can
and they won't just sell it because they've got the shits one day to sick of dealing with all this stuff. So better quality is key.
Yeah, nice. Okay. You did kind of touch on it earlier on as well, but areas that we should be looking at as an investor, any particular areas that are standing out for you at the moment?
So look, there's a lot of commentary around Brisbane looking great for the next 3 years. Adelaide, even Perth. Perth is starting to recover nicely. Major regional cities have done very well with COVID, as a lot of people look to exit Sydney and Melbourne because it's higher price and you can work remotely a lot of the time.
Yeah.
My prediction is there's going to be a little bit of reversal of that though, because if you've moved from Sydney to regional New South Wales and you don't know anyone out there, you might get lonely and move back. There's going to be, because there's been a huge amount of volume sold in places like Orange, Dubbo, even further west and up and down the coast, and prices have risen a lot. So I don't think that'll keep going, but there's still opportunities as well. So I think it's all, the big opportunities, I'll always mention commercial because that's important. Like it's storage and medical related, and, those types of like suburban type shopping centers where the social distancing is not an issue. Like that's a popular business that will keep going. And the risks are office markets, buildings, high-rise buildings like residential, where there's a lot being developed. Like, you know, you look at places like Mascot in Sydney, where they've had a lot of those building problems, and there's still like I drove down there the other day, and there's a dozen or so towers still being built, and you think, well, with all this travel restriction, who's going to be moving in there? Like they've cut the the volume of people coming into this country, which normally help those areas. So that could hurt long term, or medium term at least.
Yeah, there seems to be half a Meriton everywhere around that area. Hey,
they're going nuts, and you think, how can it keep going? And until they have enough people to fill it, and short term they don't. I don't think.
So so you kind of touched on that. So areas. So you touched on types of property not to maybe to veer away from. What about particular areas?
Look, I'd avoid probably your inner city areas for a bit, because you don't know what's going to happen with how long it's going to take for everyone to get back into the office, and people are moving to the suburbs, so that could be a 5-year fallout for it to get back to full capacity. So look, cheap interest rates and all that are going to shelter a lot of markets. Like Melbourne, there's a lot of people not seeing too much value in parts of Melbourne, so that's why there's been price falls in 2020 and 2021 starting to recover. So there's going to be some good pockets, but look, I never invest in places like mining towns or very, very regional areas as well, because long term it's just like flipping a coin. It's going to be risky.
Yeah, okay, amazing. So much value in here, Scott. So I'm looking forward to breaking this down and listening to this back again. Final question for you, mate, is for people that are maybe contemplating looking at investing. We've got our New Year's resolutions and goals for 2021. How can they get in touch with you, and what would be the process if we were to put in an inquiry or an expression of interest? What happens from there?
Yeah, so look, best is just to reach out to rethinkinvesting.com or just Google Rethink Investing. You'll see us all on the internet. And the process is we have a chat to you, work out what your goals are. So how much deposit you've got, what are you looking to do? Do you have a 200,000 passive income goal, or is it 80,000? Whatever it is, we'll work backwards and tell you how to do it. You need a minimum savings of at least 50,000 for residential, about 100 for commercial. If you've got that, you've got the ability to buy a good property. So it's just about planning and seeing what's out there, and we can walk you through the process from there.
Yeah, amazing. Scott, thank you so much for your time, mate. I know you're a busy man as well, so I'm sure there's lots of value in there for people to take away. Appreciate it.
Thank you so much for your time.